Everyone, welcome to Cigars and Syndication. I'm Robbie. I'm here with Jay. We're still smoking LFD Oro Chisel Tubo. Really good smoke, easy draw. Uh, Jay and I are passionate about real estate and we're passionate about cigars, and we're glad you're here to share today.
Hey everyone, I'm Junaid Noor. Welcome to Cigars and Syndications. And we were smoking this LFD Oro. I'm really liking the smoke. I might just go out and buy a box of these. This is a really good smoke.
I already in between was looking at how much a box costs. These It's a good smoke. I'm enjoying it as
What are they
well.
running for? They're not that expensive, like 15
It's
bucks.
about $15 a stick.
Yeah, for 15 bucks, this is an excellent smoke. But anyway, what are we talking about today, Robbie?
Today, we're just going to kind of go back and forth with some current events, some things that are happening. Maybe talk about what the Feds are thinking, Federal Reserve Bank's thinking, and when we might see some interest rate cuts. I know we had talked about that previously, and maybe we were a little more excited than the Federal Reserve was because it kind of seems like they've kind of pulled the reins in a little bit. He kind of talked about, you know, definitely going to be some cuts in 2024, but not sure when.
Yeah, and it's kind of interesting because a lot of commercial real estate is in trouble. There's a lot of distressed multifamily that's coming out, a whole lot of distressed office buildings that are coming out, and as a result, you remember we talked about this in a previous episode that a lot of the lending for these commercial buildings was done by regional banks like Silicon Valley Bank. The big banks like Chase and Bank of America don't have a big commercial portfolio. I think we said that it was only 6%. But one of the things that came out in the news just this morning was that New York Community Bank Corp, and I think it goes by NYCB, is getting $1 billion cash infusion from, among other groups, from a conglomerate of groups. One of them is former Treasury Secretary Steve Mnuchin. And one of the reasons is because New York NYCB is not doing well. Their stock went from around $14 a share back in 2023 to, I think it's down to about, what was I looking at, $3.46 as of this morning.
Ouch. Do we have any idea what percentage they were invested in commercial real estate?
I don't, but I'm sure one of our people in the back can look up some research really quickly and let us know. But the interesting thing is now that with this cash infusion, the existing stockholders get their investment is diluted now because now more stock has to be issued. So if you owned 10 shares and it was worth $100, now it's going to be worth less because somebody's coming in with $1 billion and they're going to want a big chunk of that.
Yeah, that's going to hurt a little bit. That might sting, but at least maybe they're being a little bit forward thinking, and they see this trouble coming, and it's way better to be proactive than reactive.
And I guess it's way better to be diluted than to be, to have worthless stock and you're just writing off worthless stock. So at least you have some stock left. Um, on another note, there was a very interesting article this morning about big banks petitioning the Federal Reserve or petitioning uh, the Congress to increase their capital reserve requirements. They want to increase by around 16% or so. What do you think about that?
It would definitely free up some cash. It would allow them to probably execute some more loans and lend some more money. But at what risk? And are we going to have a repeat of history?
So, this goes back to the Glass-Steagall Act, and the Glass-Steagall Act was enacted, and I believe it was enacted right after the crash of 1929. And the Glass-Steagall Act basically prohibited investment banks and commercial banks from investing, and insurance companies from investing in any other of the in any of the others. So basically, a commercial bank couldn't invest in an investment bank that sold securities and vice versa. Um, under President Clinton, the Glass-Steagall Act was repealed, and as a result, you have investment banks and commercial banks starting to merge. So Chase Bank merged with J.P. Morgan, which was a securities house, and they became J.P. Morgan Chase.
So when that act was repealed, it kind of opened up these institutions to a new world of investments, maybe some that they weren't necessarily experts in. And how did this lead to 2008?
Well, there's a really fantastic book called The History of the United States in Five Stock Market Crashes. And in that book, the author ties each crash to the next one. And 2008 was one of them. And he tied that into. So basically, what happened was that when Glass-Steagall got repealed, uh, investment banks started buying commercial banks, and what you were getting is you were getting the way banks lend money is they use depositors' money, and they have a ratio. And so what they were doing is they were starting to lend more aggressively, uh, as as if they were selling stock. So the investment banks are very aggressive about selling stock, but the commercial banks were always very conservative, right? They were much more careful about how they lend money, and then so when you got this mishmash happening, the investment banks could now, or the new combined entity could now securitize, and so they could actually loan money for a house for a mortgage, take that mortgage, securitize it, and sell it as bonds, all within the same entity. And so that's where 2008 happened, where there was so much securitization and the risk kept deleveraging, right? So you went from A paper, people with 750 scores and above, and maybe 20% down payments, who are getting their mortgages, and you're taking the cash flow from those mortgages and you're issuing bonds against that. Well, there's only so much A paper. Well, when that ran out, they went to B paper, then they went to C paper, then they went to no doc. And because Wall Street had this appetite for these securitized bonds, they kept going lower and lower and lower on the standards, until you got to a point where people were buying houses that they couldn't afford, and then everything started reversing, going back the other way. So as a result, the Dodd-Frank Act, the reaction from the U.S. government was the Dodd-Frank Act, which basically said to banks, "Hey, you have to keep your reserves very high. You can't lend this much money because it puts too much risk out there," right? And now what's happening is that the banks have petitioned to increase their capital reserves so that they could lend out more money, and not have increase their capital requirements, so their reserves are going to go down lower and they can lend out more.
Yeah, that's definitely going to open the door to some more aggressive lending, and I hope you know I hope they take that under serious debate, and because we certainly don't want to repeat 2008, but at the same time, you know I don't know if they're thinking this is just an avenue to help to help the economy, to help inflation, to let these banks get out there and be a little bit more aggressive.
Well, the upside is that if the banks have more money to lend, then the cost of capital starts going down. That means that you're going to have a boom in the economy for at least the next decade, um, where and again, I think it's all in preparation for the Fed lowering the rates. The Fed lowers the rates, cost of capital goes down, they're able to loan more money. That means the economy starts expanding because businesses, developers, people like us go and buy assets and develop more assets, and the economy starts expanding.
Yeah, and I know that Powell has mentioned that there is some concern about the commercial loans, and maybe this is being preemptive and trying to prepare the banks and have everybody ready for this environment that's about to catch up to us.
Yeah, and that's something that I'm kind of confused about, because on the one hand, Powell is saying that, well, he's very concerned about these banks failing, but on the other hand, he wants to you know, uh, let them loan more money, which means riskier lending behavior.
Some other things that are kind of happening that I think are on the positive side. I know that the mortgage rate dropped below 7, uh, and that's encouraging. And I know that Redfin released a report that after 8 consecutive months of declining home supplies, in February there was a 13% increase in supply.
Yeah, and this is all kind of this expectation that, the Fed's going to start reducing rates. So people are just kind of gearing up for that, right? So, you know, developers are going to start developing more. And the other thing is that we got to remember, and, buyers are going to start buying more too. The other thing we have to remember is that, the Redfin numbers are nationwide numbers, and real estate is very, very localized. So even within, a city like Houston, you'll have pockets where there's oversupply maybe, and there's undersupply in a lot of other pockets. But also, just so you understand that even with that 13% increase, there's still a housing shortage.
Yes, no, there's definitely a supply issue. I know here locally in the Houston area, it's a really competitive market. The home prices are remaining high. We talked on our last podcast about the different evolutions and the different types of homes and housing, whether it be owning a home or renting a home. I think it's going to be several years before the supply and demand level out.
Yeah, I think it'll be a combination of several years and inflation kind of being in control so the Fed doesn't increase rates again and the Fed keeps cutting rates. Then I think that developers will start taking the chances or the risks to build more, and of course buyers are ready to buy as long as the mortgage rates stay below 7%. It seems like buyers are buying. I don't think that we'll ever see 3% rates again, mortgage rates. What do you think?
We may never see a 3% rate again. But had you asked me 10 years ago if we would have seen a 3% rate, I probably would have said no.
That is true. My parents bought their house in 1991. They paid 9.5%, and they were like, "Wow, we got a great deal with 20% down." Um, but yeah, 3% rates are probably something of the past, and you never know.
Yeah, I mean, and I just saw an article the other day. I mean, and it's like one of your most valuable assets is a 2 or 3% mortgage.
Yes, and we did an episode on accredited investors. The reason the $1 million net worth doesn't include your primary residence is because most Americans' net worth is their primary residence. So, when the SEC says $1 million net worth, that's outside of your primary residence.
Well, I think that's all we've got for current events today. Hope everybody enjoyed this episode. We've got some articles on some of the things and topics we talked about today at albanyparkcapital.com. Grab a LFD Oro and enjoy it, and hope to see you soon.
Yeah, and we're gonna link this book. I talked about I referenced this book called "A History of the United States in Five Crashes." The author is Scott Nations, and we'll put a link to the book at the bottom of the YouTube video. Pick up the book. It's a fantastic book. It goes through five different crashes and how one leads to the next, and how the knee jerk reaction of the government actually causes the next crash. And he ties all of these crashes together. Amazing book. I think I must have read it twice already. I'll probably wind up reading it a third time because I find something new every time.
We'll see you next time.